You are a self-made billionaire with a Harvard degree in evolutionary biology. I am going to get to that, I promise. You were one of your only siblings born in the U.S., not in Mexico, and you've said that that gives you a sense of responsibility to take advantage of the opportunities here. I want to get to that too. Now, you started with $100,000. And you turned that into a $10 billion company with more than 500 commercial real estate deals. Fernando De Leon, welcome to the Property Play podcast.
Thank you for having me, Diana.
So glad to have you here. Let's just start at the beginning. Give me that, short version of how you started in this business.
It was a little bit before 2008, and the GFC was very formative and very important for us. The precursor to the business was really a moment in time where we had some residential properties that ultimately we sold to home builders right before the GFC. And
I'm going to say GFC being the great financial crisis brought on by the subprime mortgage crash, all of that.
Exactly. And so we were on the field. We were doing deals in residential lot development, and we saw some of the early indications that this was going to be a difficult sort of cycle change. And so we basically said, look, we see things here that are fundamentally unsound. We're going to take these property positions and sell them, and then kind of wait and see what happens. And so we did that in 2007. There were a lot of indicators for us. Some of the things that we saw were pretty irresponsible. And since then, by the way, we've seen that a couple of times in the real estate cycle, and we can talk about that.
We absolutely will.
But we saw that happening. We divested. We brought back some liquidity, and then we sort of waited. And then in 2008 to 2012, we became sort of fixers. We became people that were able to talk to banks, to life insurance companies, to businesses that had loan exposure, and we were able to solve problems for them. So we were sort of fixing projects that were stalled, that were half-built, that were problematic for the lenders, and we developed an expertise in being problem solvers and fixing problems that life insurance companies and banks had on their balance sheet, and that gave us a real skill set, something that we learned on and were able to hone over the years.
So you built your business out of a crisis, out of a catastrophe really in real estate, and then built that into this multi-billion-dollar company. But I want to go back even farther to how you even got into real estate, because this to me is fascinating. As a kid, you were a translator, and instead of just getting paid like any other teenager might be, you did what?
Well, as you said earlier, I was the only child in my family that was born in the United States. I was educated in Texas, and so I had this amazing advantage. I had this ability to speak both English and Spanish. At the time, the North American Free Trade Agreement was starting to go into Mexico and develop basically manufacturing capacity. And so I basically ran into a developer who was building a warehouse and a manufacturing facility in Mexico. He needed somebody to translate for him and to basically help him develop entitlements for the property and get it built, deal with GCs, and I helped him facilitate that. One of the parts of it was that he needed permits from a union, and I had a relationship with the leader of the union through my family member, through my grandmother. And so I was able to parlay that into an equity stake. And so he basically...
So instead of getting paid, you said, give me equity in the business.
Yeah,
How old were you?
I was 15. And
because all 15-year-olds do that, right?
Well, I asked him, I said, how much is this worth to you if we were able to solve this and get this building built? And he said, well, it would be X dollars. And so I said, okay, that's equivalent to about 5% of the total budget on this project. And I said, why don't you just pay me in equity? And he...
Kids, take note, definitely.
And he agreed to do it, and we became great friends, lifelong friends, by the way. We've been friends for life. But that was a pretty seminal moment in my life. And then I did that often, right? I did that over and over again, and so that was the beginning of building some equity. Part of it was, it was needed. My family, looked to me as somebody that would go live the American dream, right? I had this golden ticket, this opportunity to take the things I had learned and being bilingual, and then go parlay that into a life in the United States, and so it became a pretty formative and seminal moment in my life.
And that's how you got into real estate. Amazing. But okay, evolutionary biology. How does that shape the investor mindset?
Well, I guess I was really interested in psychology and evolutionary biology. I connected that with economics as well. So this was like early years of behavioral economics and finance, and so I was really interested in seeing why people did the things they did. I had grown up in a really interesting place along the U.S.-Mexico border. I had grown up there, and so I'd seen different cultures, different systems of governance, the way people interacted under a certain system. And so I wanted to learn more about like what drove us as human beings to behave the way we do, and so that's why I chose that field. And it was good. It was prescient. I mean, it turned out to help me make decisions about organizing companies and leadership, building businesses.
Tell me more about that, because that's the gem. What did you learn, and how does that shape how you do your business?
Look, I think some of these things are about incentives, right? Basic commercial interaction between human beings is about incentives. As Charlie Munger used to say, show me the incentive, and I'll show you the outcome. And so these, organizing principles for the businesses that we built, we learned how people were motivated, what kind of things. In certain industries, you always find sort of a status quo, a group of incumbents that are set up, and they have certain advantages, and that the organizational elements of those incumbents, understanding them from a sociological standpoint, that gave us some insight into saying, okay, this business should compete on this basis, this is where we can win, and kind of seeing around the corners. And so I guess, as a college kid, that ended up being pretty helpful in kind of letting me build businesses.
So is that why you call yourself a real estate trader as opposed to a real estate developer? And what does that mean?
Well, I guess we think of ourselves as traders in so much as there are inevitable cycles in that business, right? So we came in 2008 to 2012, we were fixers. 2012 to 2020, we were developers and manufacturers. I mean, we buy land, we entitle it, we zone it, we design a project, we lease it, we operate it. We do everything about it. We're even a GC, a general contractor for third-party developers. So we touch every part of the supply chain and development, but we also understand that, in 2021, for instance, we sold a great deal, several $1 billion of real estate because prices were high, and that was a function of low interest rates and euphoria and bad incentives in the market.
But that's when everybody was buying.
Exactly, and that's when we decided to sell most of our assets.
Were you informed by what happened in 2007? Obviously, you saw it. So you just said, "I'm seeing this again." For sure.
Yeah. Yes. In great part, we saw. I mean, part of it is understanding like where the capital is coming from, and that's something that I think I'd love to cover with you, because I think what's changed a lot of our real estate is the supply chain of money, of capital. But yes, I think, first of all, as manufacturers and builders of real estate, we always have an advantage, right? If the market trades something for $100, we build it for $75. And so when we know the exit pricing, it's easy for us to say, hey, we manufactured it, we made the widget, let's take advantage of the pricing and sell it. So it was kind of a no-brainer for us in 2020 and even 2019 to 2021 to be net sellers.
Did you see what was coming though, post-pandemic? Obviously you expected at some point interest rates would go up again.
It was mostly that. It was mostly that it was inevitable that rates would go up. It was mostly that. And also you begin to see participants in the market that shouldn't be there. And we had seen that in 2007.
So I want to get into that now, because participants in the CRE market have been changing over time. You've got institutional, first you have REITs. We talk about different asset classes and who's going into what. We've been following the deal making.
Sure.
We've been following certain bid indexes in the property play. And what we're trying to find out is, what is that signal? What is that says to you it's time to buy or it's time to sell when you see a different investor getting in?
Yeah, I mean, we call them tourists, and we see folks that are receiving capital from large institutional sources, and when they match up and that funnels through the supply chain, you begin to see distortion in pricing, and that's clear, right? I mean, if I have a warehouse that I paid $6 million for, and I think it's on my balance sheet and I think it's worth $9 million, and somebody says I think it's worth $18 million, you don't have to be a rocket scientist to understand that there are amateurs in the business that are funneling capital into that system, and that's it's sort of a yellow flag.
So let's get to now. Who are you seeing in the market? Who makes you excited about what you're doing, and who says it's time to get out?
Well, look, I think for me, the thing that I can't quite square is the data center play. And I know you've talked to some of my friends about that in the past. I look at a data center that's $10 billion, right? First of all, there haven't been any exits above $4 or $5 billion. You haven't seen comp, so that worries me quite a bit. Then I see large technology companies, the largest companies on the planet, with $4 trillion market cap, saying, I don't want to own this asset. I don't want to have this on my balance sheet. So I ask, why? Why doesn't the largest company in the world want to own its own asset? That is very, very important to them, right? This is, the AI business is everything for them today, for the large hyperscalers. And so they're saying, no, you build it,
and
you
you're
finance
speaking
it.
specifically of?
Well, all of them. I mean, most of them have outsourced the development and the ownership of the asset. All the hyperscalers have. Amazon, all of them have basically gotten financiers to develop it for them and to own it.
And some of it's circular.
Well, it's very circular.
As in they're financing them in order to finance the data center back.
Exactly. And so here's my real concern, to drill into it. I think if you look at a company that manages money for others, right, the BlackRocks and the Blue Owls of the world, these companies, they are managing money for somebody. When they put $15 or $30 billion into a data center, into one asset, it's not their money. It is the money of teachers and cops and firefighters and teachers in Texas. You know, my aunt and my cousin that are teachers in Texas, these people, it's their savings. And that's the pools of capital, these pensions, and that's the pool of capital that is inside these large financiers. It's not their money. And so when they say, I'm going to own this asset on behalf and lease it back to one of the hyperscalers, they're putting other people's money at risk, and I'm concerned about that, because those leases are big. The technology companies are telling you they don't want to own it, right? Otherwise they would. They have the balance sheet to do it. They don't want to encumber the balance sheet. They want somebody else to own it, probably because what's inside the building is going to become functionally obsolete within months, maybe years, or years, maybe months. And the optimization of GPUs, it's not the four walls, right? It's not the four walls that matter, or the land. It's what's inside. That digital infrastructure is extraordinarily expensive, and it is defying Moore's law and optimizing at a very, very fast clip. So these large facilities are now owned by financial companies that hold that liability, and they're amortizing it into 15 or 20 years. And I suspect that what's in those leases, it's what we call Swiss cheese lease, right? There are a lot of holes in that lease that allow the counterparty to remove itself from the lease and the obligation over time. So that's my concern.
So do you equate the data center with the subprime run-up, and do you expect an equal type crash?
I don't see that. I think subprime was a demonstrably diffuse phenomenon, right? I mean, that was 4 or 5 million people owning individually a mortgage. They were securitized. There was credit default swaps that were layered on top.
But you had builders overbuilding, way overbuilding, because they saw the ability to sell it. I mean, we're building, what, half as much today than we did back in 2006, 2005, that run up. Is it the same, though? We're building tons and tons of data centers that, as you say, are going to become obsolete or are going to become unnecessary?
Well, we'll see what the timing around that is. I'm just concerned about the lease, the owners of the lease who are probably underestimating those risks. But I don't think that subprime and data center, that you can correlate those two things. I think back then you were talking about commercial mortgage bonds that were securitized with bad ratings, that had overlaid credit default swaps, that had insurance 10 times over. So these were bets on bets on bets.
It was much messier.
It was very, very messy. This is one company with a lot of investors holding a lease on a $20 billion asset, and is there a market for it? Now, you know, Meta and all those hyperscalers, they're on the hook for that lease. The question is, what is the totality of the picture of that lease for a liability that needs to amortize a $20 billion asset. We just never seen something like that before.
So have you been in data centers? Are you invested? No, absolutely.
No, that's not for us. I mean, look, we're private investors, and we're looking for things that are, have plenty of downside protection, and we're using a lot of our balance sheet, right? I mean, I'm investing for every dollar that we invest, I'm investing 40 or 50 cents. So we don't have an interest in pursuing those risk profiles.
And some of those other people who are investing, the newbies, as you call it, we see a lot of family office, a lot of multifamily office as new players in this. Yeah. What do you think of that?
Well, look, I think we have many family offices, large families in the United States and Europe and Latin America that co-invest with us. And these are very, very sophisticated organizations, right? I mean, these are folks that I interact with that have 50 to 100-year time frames. They are not making short cycle plays. So when we make an investment together, we see a long-term horizon that doesn't worry me, because you can, if you don't have too much leverage, you can deal with a lot of cyclicality and own things long term. So I think the family offices that we deal with, at least, are extremely sophisticated.
So just to round it out, you talked about when you see different players coming into the market, and the hyperscalers are one that you say is the one that scares you the most. Is there anyone else who causes discomfort in the market right now, who's kind of new to the investor, or who's building their investments?
I think we see. First of all, on the hyperscaler question, remember, when you look at real estate, you've got to see the different asset classes as, a hotel signs a lease nightly, an apartment building signs a lease every year, a data center is signing a lease 15 to 20 years. So the balance of power between one group, between the tenant and the landlord, shifts based on that commitment. You can ask a tenant in an apartment building not to sign a lease, and you're fine, right? Because you've got 300 other apartments to lease. Whereas here, it's a one-to-one relationship, and that balance of power is hard to manage. So we look for things like that, and so I would say, there's a lot less risk for individual investors and middle market players that are new entrants if they're buying an apartment building that's under leveraged at 50 to 60% leverage. You can withstand cycles. So I think it depends on what asset class, what the capital structure is, where people are investing. You can deal with cyclical questions in real estate if you're well structured. So it all depends.
So I have to ask, what does evolutionary biology teach you about what the hyperscalers are doing?
I would just ask myself the question, why don't they want to own these assets if they're the largest companies on the planet?
Interesting. Okay, you invest in properties, obviously. You invest in debt and other types of structures. You also are investing heavily in information. You helped to co-found CRE, which is a real estate platform that does data analysis, et cetera, and also helps to facilitate deals. Why did you want to start that?
It's interesting.
Because you got 4 million people now on that platform. 5 million. 5 million, okay.
So I will tell you, that's a funny question, a funny story. I was looking at an office building deal to invest in, and I looked at how capital intense it was, and I was looking at how much you needed to build out a floor, and it was an 8-story building in Texas, and you needed about $1 million of capex to build out the floor, each floor.
Capital expenditure.
Capital expenditure. So I said, man, that is way too much money. And so I started thinking, what is the opposite of office buildings in real estate? And I said, the opposite of office buildings is data. And there's a gentleman by the name of Mike DiGiorgio who agreed with me. And we started talking about this, and it was his idea to push this. We built essentially a listing service where we could facilitate brokers, give them tools so that they could market their products.
So is this like Zillow for CRE?
Like Zillow for CRE. So we basically were a listing service that facilitated their ability to market the properties. So today we have 5 million people. They're brokers, investment sales brokers, leasing brokers, buyers, sellers, landlords, tenants. All these folks are using that platform. And as they upload information on our
site. You
site.
get the data.
We ingest the data, we synthesize it, and then we are able to resell it, comps for lease comps, sales comps, things like that. And so it's become a very, very good tool for the commercial real estate industry.
Now, I hate to ask this because everybody does AI, and AI is involved in everything, but really when you get down to it, some of these companies that claim they're using AI in their property technology, it's just software, it's just regular data like you're talking about. Do you incorporate AI, and if so, what is the real impact of AI on all this?
Well, the real impact is that AI technology today at CRE allows us to take a brochure, a package that a broker uploads onto our site, and basically ingest and synthesize all of that data. It used to be either limited software or manual, and so now we're at a point where that technology allows us to get all of the salient points and then to cross-reference it with all the others, and the technology has the ability to cross-reference information in a way that we just haven't had ever. So it's powerful.
So boiling it down to basics, how is the data really reshaping how deals are sourced, valued, and closed?
Yeah. Well, you know, it's a little bit ironic that at CRE we have made the industry so efficient. We've made it efficient because people have access to so much information now. We are one of the repositories of that data that distributed to our industry. But by doing so, people can access lease comps and sales comps in a way that is very democratic. And by doing that, pricing has become much more efficient. So you see a little bit of that in the public equities markets, where retail investors and folks have come in to buy stocks, and they have much more information available to them, so they can manage their portfolios that way. So this has done that both for commercial real estate professionals, for individual private investors, family offices, institutions. Everybody comes on our site and accesses that information, and it's become very, very powerful for them to sort of empower them to make judgments on how to lease it, where to lease it, and the terms of the transactions that they do on the site.
And I wouldn't be a good journalist if I didn't touch on the downside of this, which is the bigger you get, the more lawsuits you get, and you are currently in a big one with CoStar.
Yeah, so that is, you know, it's business, but I will tell you this. I think that is an important question for the real estate community, for the commercial real estate community.
Because what are they charging?
This is a question that is important to all professionals in the industry. The question is around who owns intellectual property and photographs. So when a broker uploads a property on the site with photographs of the building, of the interior, who owns those photographs? Is it the broker who uploaded it? Is it the property owner? Is it the site? These are questions that you know, technology has advanced, and that the courts really need to provide direction on to keep up with the technological advancements.
Okay, so you've also moved in, you're very heavy into healthcare, but you invest not just in healthcare properties, but in healthcare itself. How does that inform the real estate side of it?
Yeah, so I think when we started, obviously, in the real estate business, but we would have, you know, shopping centers where we had a tenant, for instance, that was a veterinary clinic. And that veterinary clinic, we saw their economics. And we saw that the economics of a vet clinic with a boarding facility for pets had better economics than a hotel down the street. So we were boarding pets at a better rate than hotels down the street, right, for humans. So we saw these economics in healthcare, in veterinary healthcare, and we used our real estate development capabilities to go build new locations and grow businesses in veterinary care and dental. We're the largest operator of med spas in the country. We have a mental health business called Turnwell. So we've used our understanding of demographics in real estate, where we were, you know, apartment builders and demographics experts, and we understood where markets were growing. We understood what was happening, you know, in the suburbs of the Carolinas or Florida or Texas. We understood where these markets were growing, the demographics, and then we parlayed that demographic understanding to build healthcare facilities across the country in some of these categories.
So outpatient medical buildings, we just did a piece in the Property Play newsletter about the growth of these outpatient buildings, a lot because the healthcare systems want to get people out of the hospital where it's much more expensive and get them into the outpatient care, and that of course is fueling this outpatient building. Do you love that play?
We love that play, and the economics look very convincing for that, because hospitals, if a procedure for an orthopedist costs $10,000 in a hospital, it can cost $3,500 in an outpatient ambulatory center, and so that cost differential makes a lot of sense to put in a different facility with a different cost structure. So the economics make sense. When we see economic situations like that make a lot of that are logical, we tend to invest in them.
So you talked about demographic drivers. Let's talk about growth in the Latino population. Sure. We know that in home ownership, it is the fastest growing
Sure.
sector of home ownership. Where do you see it in the commercial real estate market specifically?
Yeah, I mean, look, first of all, the Latino demographic in the United States, about 65 million Latinos in the country would together constitute about a $4 trillion GDP economy, which would effectively be the fourth largest economy, tied with Japan. So it's a very, very big economy. And they're forming households at a much faster pace. They are very essential in certain industries, right? In construction, and agriculture, and hospitality.
And that's how you got your start.
Yes, and so we've seen. The growth of this demographic is the engine of the United States growth in the GDP of the United States.
And it's not taking a hit from the current administration?
Well, I mean, look, I think in Texas you see this, right? In Texas, about 40% of the total population is Hispanic, and that is the driving demographic in the growth of Texas. And Texas's GDP grows at the fastest clip, job formation grows at the fastest clip. I think for sure there are a lot of changes that are occurring right now in terms of immigration, but I think over time these things should settle. I think the administration will have sort of get its own footing on developing a message on this question of immigration, illegal and legal immigration.
So what is the best play in that sector?
In the appealing to the Latino demographic? Look, I think Hispanics are acclimated and assimilated to all of American consumer elements. So any business we touch is going to have a large tailwind from that demographic, whether it's apartments, or they're buying goods and services in our healthcare clinics or in our warehouses. All of it is connected. So I wouldn't. I don't differentiate. I don't differentiate, but I do look at places like Florida and Texas that have that household formation pushing GDP, and they're growing those economies. So we're more sort of geographically investing and focusing on places like Arizona, Texas, Florida, the Carolinas. Those markets make a lot of sense to us based on the demographic tailwinds.
Okay, so using all of your expertise, I want to get your big picture, final CRE play. We know you don't like data centers. I got that. Believe it or not, I got that. What are the sectors that you think are really poised for a big rebound? Because we are in this kind of U-shaped commercial real estate recovery off the interest rate drop and then the increase in interest rates slowly coming down. Where do you want to be? Where don't you want to be?
Look, I think about the real estate business in micro markets, right? You could tell me about an apartment building. We have apartment buildings where one is struggling and it's across the street from one that is thriving. And that could just be the difference between the school district that apartment building is zoned to, right? People want to send their kids to a certain school. And so we see these micro markets. I would rather, look, we're invested in healthcare, real estate, apartments, the multifamily sector, industrial.
Even though apartments seem to be overbuilt right now and rents are weakening.
In some markets, but we still see plenty of opportunities in certain pockets, right? We're building a project right now in Phoenix that is about half a mile from the TSMC plant that has 5,000 new employees and like 1,000 units of housing, right? So there's this imbalance there in that micro market. So that is something that we would look at and say, okay, that makes sense to us. So I tend to not to make generalizations, but in those sub-asset classes, we find micro markets that make a lot of sense, and it's got to make sense demographically. The capital structure has to be right. We're also doing a lot right now. One thing we're very bullish on is recapitalizing existing projects for others as a lender and as a credit shop. So we provide mezzanine financing. We provide senior financing for projects in those asset classes, and usually, we can get our arms around something on the development front that we tend to understand because we have that background, and so we're doing a lot of work on the lending front.
And what do you expect will surprise most people about the next real estate cycle?
Well, I think one thing that we've seen is that if there were 100 players in every sector, I think you've seen a culling of maybe the bottom 20%, 25%. So that's already taken hold over the last 3 years of this very difficult.
People are getting out.
Yeah, and by necessity, right? There was no more capital for them to do anything, and so that changed. So that's already been important and relevant. The second part of it, I think, is you will begin to see a lot of more capital come into the business. I think
from who? From
wealth management firms, RIAs, pensions, sovereign wealth funds. I mean, there's about $110 trillion of wealth transfer from the baby boomers to their children. All of that capital is embedded in our financial system, and when the allocations to real estate go from 3% to 6%, that number means that there's like $4 trillion more of capital that is chasing a finite number of real estate assets. So when that happens, you see an oversupply of capital. You'll see price appreciation for fundamentally sound real estate assets. And so I think the story of the next 10 years will be that the real estate capital markets will grow tenfold.
Fernando De Leon, thank you so much. It was such a pleasure.
Thank you.